chance to talk about it. Thank you so much, Mr. Mehta, for joining us this morning. And let's talk about the H1 borrowing figure. Given the fact that the H1 borrowing figure is a tad bit lower than what the street was anticipating, what's your view on it?
No, I think Street is quite happy because Street was expecting more than previous year front loading, but that's not happened. In fact, it's much lower than the expectation. That's the one good part about the borrowing program. Another thing is also they're kind of restricted to securities, so that kind of gives you a window. So typically you will have one security issuance once a month kind of situation. So that also will help the trader sentiment in the market. And I think overall, yes, this is at a margin helping. But overall, the view, of course, is on looking at the rate cut and further liquidity measures. So that is the main situation on the bond side right now.
And I was, going to come to that itself, Mr. Mehta, because you think if A, would it be front-loaded, and then B, would it really sort of avoid any upward pressure on rates when the RBI is already infusing liquidity at a record level pretty much?
So typically, of course, you see, from second half to April, May, the demand actually start picking up for the bond. And at the same time, right now, the expectation is fully factored in for a rate cut for April. And of course, once the policy gets over, depending on the statement, I think the expectation for June rate cut will also start panning in. Of course, they've kind of reduced the 30-year, but they have kind of increased 40 and 50 years. So from that perspective, also, we would see some spread shrinkage there. But more importantly, yes, the demand is good. This will help at the margin, the lower borrowing program than the expectation. But overall, the bias is towards further more liquidity, further rate cuts. There is definitely comfort on the inflation, and that will continue to remain for the time being.
Right. I wanted to get your view on the rupee, given the fact that now you have a lot of them expecting the rupee to actually strengthen by year end. The scenario has changed. A lot of them were expecting the rupee to weaken to about 88.5 by the end of this year. Now that sort of an expectation is getting revised to around 87.5. What's your view on rupee? Do you think the worst is over with the currency, the weakening of the currency when you compare it against dollar?
That is, you guys are expert on equity. If you guys believe that equity flows are going to continue, what we saw in last few weeks, if that is going to continue, that will definitely help. I think, you see, when you look at it, FPI flows are very crucial. You see, I have been always advocating that people worry about, crude price, which is our largest import, but then, $10 crude price change would actually impact over a year, right? Whereas FPI selling $500 million, it impacts you next day, right? So that is where the impact is immediate. And that's where, if the flow continues, we have to see what happens globally, what happens on the 2nd April. It is dollar strengthening, dollar weakening. So it's more to do external rather than more about India internal.
Right. So talking about internal, we did speak about rates, and the expectation now is that hopefully we will have a looser monetary policy, though you did mention about the fact that we will have a looser monetary policy. But when you talk about all of that, what does it mean for the inflation, the growth prospects going ahead?
So I think, you see, if you look at the preamble, which always they say is inflation and growth, right? And definitely there has been talk, there has been a little bit slowness on the growth than the expectation. And whereas at the same time, inflation is curtailed, people are now looking at maybe fourth quarter for FY25-26. Now, if that is the expectation on inflation, and as of right now, doesn't look that view will change, at least in this policy. Maybe in June, of course, we always have this factor of monsoon. But beyond that, sitting today, it doesn't look like inflation goes beyond four quarter or so. And from that perspective, you have enough headrooms to lower your real rate, which is the government bond yield minus the inflation. That definitely should help.
Lastly, do you believe that this sizable liquidity infusion that we're seeing from the central bank, that's going to continue?
So I think definitely we have seen the liquidity, but we still come to a neutral kind of a stance. People would really look at what does RBI say in the policy, whether neutral stance or an accommodative stance. But irrespective of what that is, I think we had been in a negative liquidity. From there, we have already come to neutral or mildly positive. We'll have in April. And on the policy, if it is suggesting accommodative, which they can justify because inflation is in control and growth is kind of at a margin struggling. So therefore, you can move to accommodative stance, and if that happens, that gives you a sustainable comfort to the banks and traders in the bond market that liquidity will continue and it will be given. The stance would be important, washed out, but even without stance, I don't think they are going through negative liquidity now at this for next 6 months.
Need of the hour pretty much to propel growth. But Jayesh, so good having you today on the show. Thanks for your time. Okay, let's move on. Let's just address.
If you like this video, then like, share and subscribe to ET Now.